The letter from the bank did not say she had done anything wrong. It said that the bank was implementing revised collateral requirements for agricultural operating accounts, effective the first of the following month. It said that accounts with a loan-to-value ratio above a newly established threshold would be required to either provide additional collateral or reduce the scale of their operating line to bring the ratio into compliance. It said the bank valued her business and looked forward to continuing the relationship. Patricia Wald read it twice at the kitchen table, in her farmhouse outside Linton in Emmons County, North Dakota. Then she set it down and went out to do the evening chores because the cows did not care about bank correspondence and the work did not wait. She was 44 years old. She had been running the 520-acre farm alone since her mother-in-law's death in 1979 had left her the sole decision-maker on an operation that she had been managing in practice for the previous 4 years anyway, while her husband's illness had made him unable to work. Her husband had died in 1980, 14 months after his mother. Patricia had handled both losses and kept the farm moving in the same year. She had no male advisor in the formal sense that many farms in Emmons County had. No father-in-law still farming nearby. No brother who had stayed on the land and could be called for a second opinion. No older neighbor who had taken it upon himself to look out for the widow's operation. She had the county extension agent, who was helpful and knowledgeable and not always available when she needed him. She had the loan officer at the bank, who was professional and whose advice she weighed carefully, knowing that his interests and hers were not identical. She had the farm record going back to 1971, a calculator on the kitchen counter, and 11 years of making every financial decision herself. Some of those decisions had been wrong. She kept a mental list of the ones that had cost her money and what she had learned from each of them. The list was not long, but it was specific, and she consulted it whenever she was working through something that felt similar to a previous mistake. The bank's letter was asking her to make another decision. She went out to do the chores and let it sit. No partner to call, no father-in-law down the road, just her and that letter, and the numbers she'd been keeping since 1971. Most people would have froze right there. She went out and did the chores, let it settle. That's a kind of strength you don't hear much about, but it's real. The farm's loan-to-value situation in the spring of 1982 was not unusual for Emmons County. Land values in North Dakota had risen sharply through the late 1970s as grain prices were strong and land was seen as a reliable store of value. Patricia had refinanced the farm's land debt in 1978 at what had seemed like a reasonable ratio. $186,000 borrowed against land, appraised at $410,000, a loan-to-value of about 45%. That had given her comfortable room above the bank's standard thresholds. By early 1982, the picture had changed. Land values in the county had softened as grain prices fell, and the broader agricultural economy contracted. The bank's new appraisal of her ground, conducted as part of the portfolio review that had generated the letter, had come in at $298,000, $112,000 below the 1978 figure. Her land debt had come down from $186,000 to $161,000 through 5 years of payments. But the ratio of debt to appraised value had moved from 45% to 54%. The bank's new threshold was 50%. She was 4 percentage points outside the line. The letter offered two paths. She could provide additional collateral, equipment, other property, a co-signer, to bring the effective ratio below the threshold. Or she could reduce her operating line by enough that the combined debt to value fell into compliance. Reducing the operating line meant reducing her planting program, which meant reducing her revenue, which meant a smaller operation and a longer road back to the position she had been building toward. She sat with both options at the kitchen table for 3 evenings before she started writing anything down. She had learned over 11 years of making decisions alone that the first evening with a difficult problem was for understanding what the problem actually was, not for solving it. The second evening was for running the numbers. The third evening was for sitting with what the numbers said and asking whether she agreed with them. The collateral option was technically available to her. She owned the equipment free and clear. A tractor, a combine, a planter, an assortment of smaller implements, collectively worth approximately $68,000 at current market values.
Pledging the equipment as additional collateral would bring her ratio into compliance without changing her operating program. She could plant the same acres, produce the same crop, maintain her cash flow projection. The problem with the collateral option was that it converted unencumbered assets into encumbered ones. The equipment she currently owned free and clear would become security for a loan. If the operating season went badly, a drought, a price collapse, a machinery failure that cut her yield, and she could not service the debt, the bank's claim would extend to the equipment. She would be farming with machinery she did not fully control. She had been in that position before, in the early years of the farm. She had worked her way out of it specifically because she had understood, through experience, what it felt like to make decisions about a farm when the bank held claims on the tools you needed to run it. She did not want to go back. The reduction option meant accepting a smaller operation for the years it would take to bring the debt ratio down through a combination of payments and, if land values recovered, appreciation. She estimated that path at 3 to 4 years before she was back to a comfortable operating scale. 3 to 4 years of constrained cash flow, deferred maintenance, limited ability to take advantage of any opportunities that came along in the land or equipment market. Neither option was good. One was bad in a way she could manage. The other was bad in a way that changed the structure of what she owned. The voices in her community were not unanimous, but they leaned in one direction. The neighboring farmer who farmed the section to her north told her, when she mentioned the situation in general terms at the elevator, that he would have pledged the equipment without thinking twice. He said the operating program was what mattered, and that protecting the current year revenue was the priority. A woman who ran the Farm Bureau office in Linton said that several other operations in the county were facing similar requirements, and that most of them were providing the additional collateral rather than cutting their programs. Patricia listened to both of them. She did not tell either of them what she was going to do. You listen. You take it all in, and that's fine. But at the end of the day, your name's on the deed and your name's on the loan. Everybody else goes home for supper. You're the one that's got to live with it. She called the bank on a Thursday morning and told the loan officer she would be reducing her operating line rather than providing additional collateral. The loan officer said he understood and asked how much she wanted to reduce it. She had the number ready. She had calculated the minimum reduction that would bring her ratio into compliance while preserving her ability to plant the highest value acres, the eastern fields with the best soil, the ground that had consistently produced above her average yield. She would fallow the lighter ground to the west for one season, reduce her fertilizer rate on the middle sections, and concentrate her inputs where they would produce the best return per dollar spent. The reduction in operating scale for 1982 was approximately 140 acres of planted area, from her normal 480 acres of small grain and sunflowers down to 340. She kept the 180 acres of her best ground in full production. The remaining acreage was fallowed. Her 1982 crop revenue was lower than a normal year, approximately 70% of what a full program would have generated. Her operating costs were lower in proportion. Her debt ratio improved through the season as her land payment reduced the principal and the bank's threshold calculation moved in the right direction. By the end of 1982, her loan-to-value was at 51%, still slightly above the new threshold, but close enough that the bank did not send another letter. The reduced program had required her to be precise about where she was spending her input dollars. She had concentrated her fertilizer on the eastern fields, accepted lower application rates on the middle ground, and left the western sections completely fallow. The eastern fields produced above her average yield. The middle ground produced adequately. The fallow sections rested and, she believed, would come back stronger the following year for having been left alone. The 1983 season, she planted 400 acres, bringing the lighter western ground back into production at a modest input rate. Her yield was adequate, and her ratio continued improving as the debt principal declined. By 1984, she was back to her full 480 acres in production.
The land values in Emmons County had not recovered to their 1978 levels. They would not fully recover for years. But her debt principal had declined enough through consistent payments that the ratio had moved back below 50% on its own arithmetic. The equipment remained unencumbered through all of it. She had never pledged it. In 1986, when a neighboring operation 2 sections to the south went through a forced sale, the equipment auction included a tractor and combine that the bank had held as collateral since 1982. The farmer had pledged them during the same round of portfolio reviews that had sent Patricia her letter. The operating seasons between 1982 and 1986 had been difficult enough that he had not been able to service the debt, and the bank's claim had eventually been exercised. The tractor sold for considerably less than it had been worth when he pledged it. Patricia attended the auction because there was a disc harrow in the sale she was interested in. She did not buy the tractor or the combine. She noted the prices in the small notebook she kept in her truck and drove home. She had made 3 to 4 difficult years, the price of keeping her equipment free. The years had been difficult. The equipment was still hers. Not every right decision is easy. Sometimes it is simply the decision you are prepared to live with when the years that follow it do not go the way you planned. Patricia Wald had chosen the harder path in the spring of 1982, and the harder path had kept the tools in her hands. If you were in that position, would you have pledged the equipment to protect your operating program or accepted the smaller season to keep your assets free?